Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives that are shaping the global investment landscape. In this final episode of the 2024 Outlook series, we discuss our view on alternatives. Very broadly, alternatives are a good source of diversification when added to traditional equity bond portfolios. Also, recent trends have shown that some of the alternatives like private credit are now going mainstream. Therefore, alternatives in multi-asset portfolios have gone from a good to have to a need to have. While alternatives are a very broad bunch of assets, in this episode we discuss the outlook for crude oil and gold. Let's begin with the crude oil. Oil prices are likely to be range-bound over the next 12 months. On the supply-demand dynamic, we think persistent supply-side concerns and discipline of the OPEC Plus are likely to put a floor under the prices. While many expected inventory builds in the first quarter of this year, global onshore crude stock dropped by about 24 million barrels in January, according to high-frequency data. Although global stock builds are expected between March and May, unexpected draws over January and February or shallow-than-expected stock builds over March and May would translate into extremely bullish backdrop going into summer. At the same time, limited demand growth is likely to act as a cap. Further, spring refinery maintenance season will also likely mean limited upside to oil prices. Given our expectations for structurally higher oil tanker freight rates and continued growth in US crude exports over the coming years, we expect Brent WTI margins to widen. Despite elevated and volatile refining margins, it is still the locational component rather than the quality component that drives our forward view on crude differentials. Now, moving to gold, we have a more neutral view for the next 6 months. We expect the prices to stay higher, but the upside from here looks limited. Gold prices have rallied strongly in the later part of 2023, and the commodity now, along with other asset classes, appears to be pricing in more interest rate cuts than what major developed world central banks can actually deliver. Real rates and the US dollar influence gold prices considerably. Here, in the next few weeks, both real rates and US dollar are likely to move higher and cause weakness in gold prices. But beyond that, we expect them to turn more supportive of gold. Rise in geopolitical risk helps the investment case for gold, but we do not see a significant risk-off event as our base case. The supply of gold is rising while the demand side is rebalancing from retail customers to central banks, thus keeping status quo at the headline and implying a more neutral outlook. On the supply, higher prices meant increasing supply with mining output rising and recycling rates higher. On the demand side, ETFs are liquidating while OTC and real money purchases are rising. Central bank buying remains historically high. Jewelry and coin and bar demand is weakening at the same time. Overall, we think it is prudent to hold gold as insurance against any risk off in multi-asset portfolios, but we see limited upside in our base case. In summary, for oil, we see a more range-bound price and expect the Brent WTI margins to widen. On gold, we have a more neutral stance after the strong rally over the recent months. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information on our investment strategies, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com. You were listening to the Global Investment Insights podcast from ADCB Asset Management, and my name is Kishore Muktinutalapati.